a possible IPO from Saudi Aramco. All that and more on this Energy and Materials edition of Industry Focus. Good morning, foolish listeners. I am Sean O'Reilly, joining you here from Fool Headquarters in Alexandria, Virginia. It is Friday, April 22nd, 2016, and joining me to talk about the latest in the world of energy and materials is the one and only Tyler Crow. Long time no see, Tyler.
It's been a week. You know, we had a little fill-in for you. We had a lawn ornament take your spot.
I about died when I saw that.
Yeah, it was pretty good. It was fun.
It was pretty...
He was very insightful.
I'm sure. Probably more insightful than yours truly. But you guys had a good show. I enjoyed it. I listened to it from northeastern Ohio. I visited the parents.
Have a good time?
Yeah, no, we actually completely unrelated to our topics of discussion today. But I'm going to plug my hometown for a second. Lots of exciting things are happening in downtown Cleveland. Like they're building apartment buildings, and they put in like a fancy Heinen's inside of an old bank building, and it's just weird to see because I don't think of Cleveland as an urban living city. And long way to go.
It must be all the good news around all their sports teams that just really has everybody excited.
It's okay, Tyler. It's okay. I don't want to talk about it. I grew up in the 1990s when the tribe was hot. And anyway, cool. So diving in real quick here, we're starting to get a trickle of earnings releases from a few of the people in our sector.
Yeah. Early reporters every single time this year, you get a couple of the early oil services companies like I would call them the diversified oil services companies, and you also get early indications from Kinder Morgan. I think a lot of what's been going on as of late is pretty much what everyone would have expected.
Right.
If you look at things like oil prices, you look at things like rig counts in the United States.
Which, ironically enough, I couldn't help but notice in the Core Labs release. That was like in the first paragraph was the rig count. I'm like, yeah, you guys want everybody to know.
Well, Schlumberger mentions it too. It is very, very hard to make money when you are a drilling contractor or do some sort of oil services business, when the rig count in the United States is the lowest it's ever been
since the 1950s.
Since we have records of it. It's around 400 right now, which is just mind-bogglingly low. And if you looking at some of the results, it's pretty reflective of that. Even CEO Paul Kipsgaard at Schlumberger, notice he's like, this is one of the worst cash crunches that I have seen in the oil patch in my career. And, if you look at the revenue and earnings breakdown of the company, they break it out between North America and international. And if you look at international, it's down by, 20%, and they're still generating operating income of about 20%. Actually, I have the
which
numbers right here.
We were told that international would be a lot better than North America.
Yeah.
On our trip to Houston last October by Distribution Now and everything. They were like, yeah, and it's because these are national oil companies, longer tail projects. But
so international pre-tax operating margins at Schlumberger still in the 20%, which is great.
It's positive. That's a good thing.
Revenue is down year over year of about 28% on the international side, which doesn't sound too bad. But then you look at North America, revenue down 55%, and pre-tax operating margins have actually swung into a loss of negative 0.7%. And I think in the next couple of days, when you have Halliburton, Baker Hughes, a couple of the other oil services companies that are much more tied to the North American market, I think you're going to see
even worse
some struggles.
Right.
So I think investors who have a stake in some of these other companies, just be ready, because it's probably not going to be pretty.
When I was reading the Core Labs and the just Core Labs, I was most interested to see them, but it was pretty meat and potatoes, and it's what you would expect. What did you think about Caterpillar's results? Because they are extraordinary, obviously very, very tied to the mining industry.
Right.
And the results weren't that bad, though. They had quarterly revenues of $643 million. It was down 7% compared to the same period last year. I mean, that isn't complete devastation. They're still profitable.
Yeah, they're still profitable. It's just that if you look at the numbers for everything Caterpillar, to say hanging on by the skin of their teeth.
Right.
That might be a little bit too far of it. But if you look at anything when it comes to mining or energy and materials, or for them, it's just getting absolutely hammered. There are a couple, I guess you could call them saviors for them. They have their financing arm, which has seen some only modest declines because you've got people still paying off equipment. And one of the things that was mentioned in their release about their from their CEO was that we think we're pretty close to the bottom here. I mean, it would not be surprising if things were to decline a little bit more, but we don't think we're going to see much larger declines from where we are right now. And we feel like we have made the adjustments to our cost structure that we can handle being today. And if you look at the final results, they still remained modestly profitable, and cash is coming in the door, not a lot, but enough that you don't have to hit the panic button yet. And we're looking at a company like Caterpillar. Their pricing stayed relatively well because they have branding power. They have a certain level of trust when somebody is going to buy a 6-7 figure piece of equipment.
Yeah.
You want quality. You want something you can depend on. You want a company that's going to be around to fix it. And so, so with something like that, Caterpillar certainly has those advantages, and it's looking much, much better than it has in the past 6 to 12 months.
Given the indications that we might be at the bottom of this cycle, is this when you kind of step up and start picking up a few shares in some of these names?
Caterpillar has certainly been on my radar for a little while. I've been kind of watching, trying to figure out how they're going to handle their debt situation. They do have a pretty large amount of debt, but they are a manufacturing company. So when you compare it to some other people, if you were to compare Caterpillar and Starbucks or something like that, you'd be bewildered at the amount of debt that Caterpillar had. But then if you
business models,
if you start looking at the heavy capital costs that are involved in building all this machinery and having large inventories that are going to last a very long time, you're not turning over a front end loader in 12 days or something like that. It may take much longer for it to sell, so you have pretty high inventories. So they just has a higher debt capital structure, but just watching it and making sure that it's not having to blow out the bank during this downturn, which makes it look a little bit more promising than, say, 12 months ago when things were still rapidly declining, and kind of watching it be like, whoa, are they going to have to make some drastic measures? And they've made some labor cuts, and they've certainly brought their operating costs down, but not enough. They haven't had to do the big, deep cuts that you would assume somebody would have to do in a situation like this.
Yeah. So obviously, talking about oil for the last 18 months has been, I don't want to call it depressing, but I don't have a better word. Mining's not doing so hot. Are there any companies in the energy industrial space that might make one hopeful of the future?
I think actually one that looks pretty interesting not from an oil and gas, but from a overall energy perspective. If you kind of look at the whole space, I really have been kind of impressed with what's been going on at General Electric. Obviously, oil and gas has been, that segment of the business has been getting hammered just like everybody else. I mean, no shock there. But they're doing some very interesting things in the oil and gas segment, and they're also getting some better results from across the board. If you look at their renewables segment, which is something they just started breaking out in their earnings, you have a renewable segment that brought in $1.6 billion in quarterly revenue, which is 66% greater than what we saw in the previous year.
Yeah.
Part of that had to do with the Alstom acquisition that they made back last year, basically buying it's all of its wind turbine and other power generating facilities.
They were already a big player in wind turbines even before that.
And so you add Alstom to that, and you've got a huge wind, and they have some solar. And again, some interesting things they're doing in oil and gas. They even mentioned it in their release, where they have done a kind of a new model when it comes to oil and gas equipment manufacturing with rig company Diamond Offshore. Basically, has provided all of the blowout preventers. It's a major piece of equipment that is one of the, I would say, the bottlenecks of the oil and gas drilling industry. Like this thing has to run perfectly. It has to go on scheduled maintenance, and there's a lot of downtime associated with it. Anytime there's downtime, you're not making any money. And so what they have done is they have bought back all of their oil and gas or the blowout preventers from Diamond Offshore that had originally purchased, and now are leasing them to them. And the goal of this for Diamond Offshore is GE has some skin in the game. They want to be better about maintenance and keeping it operating, and they get incentive bonuses based on getting better performance metrics than they already have. And in exchange, GE gets a reoccurring revenue rather than a straight sale. So over the long term, that asset becomes more valuable. And if it can pull levers like that in the oil and gas industry, while at the same time seeing this huge boom in other sections such as renewables, GE is looking very impressive, at least on the energy side of its business.
Yeah, and given their shift that they're in the midst of making towards getting back to their roots of being a good old American manufacturer, it seems, I don't think I'd be going out on a limb to say that they're a decent bet if you want to get in on the alternative energy, high-value manufacturing game.
They are doing a lot of things that are very impressive. You know, they're really trying to divest themselves from GE Capital. They said in their release they're about $166 billion worth of that has been divested. They're a little ahead of schedule on that. And when they get rid of all of these GE Capital that are kind of ancillary to the, this typical financing arm that you'd see at a Caterpillar or a John Deere or something like that to help fund the purchase of a major piece of equipment. Once they get rid of that, they're going to be able to get rid of their CFI, sci-fi, whatever you want to call it, designation, basically saying they're too big to fail as a financial institution.
We don't matter to the financial industry anymore.
Right. They want to get rid of that, and in doing so, they free up a lot of their capital and cash and things like that they can then return to shareholders. They're looking at doing a massive buyback, a sizable dividend increase, and once that capital aspect of it and they get back to being a true industrial manufacturer, and if you look at those numbers, they're becoming a pretty good industrial manufacturer again. Yeah, things do look very promising for GE. Like Caterpillar, GE is another thing that's I have been watching pretty attentively as of late.
And real quick before we move on, I was interested to get your thoughts on the airlines. These guys have, you think of an automatic beneficiary of low oil prices.
Oh, and they have been.
Immediately. Yeah, except for, who was it that had like really high-priced hedges that hasn't really benefited? Anyway, no big deal. Anyway, but you mentioned before we went on air that you'd been looking through their results, and I think Alaska Air and Southwest have reported some good and some bad.
I wouldn't say call it bad. It would more just be like neutral. Flatlining, very neutral. So some of the good things that you see, obviously the headline number says they made some of their best return on invested capital numbers. They made some of their best profit numbers in a quarter, which all sound great. And then when you start to break down what those are, some of the gains that they had, you saw a modest uptick in total miles flown. Basically, they're scheduling more flights. They're building out a little bit more, few new routes, things like that. But they're very measured when it comes to those things. Their load factor, and this is actually an important metric when you're thinking about the airline industry. Load factor is basically how full the planes are at any given time. And, you saw a modest uptick in that. They're, I believe, somewhere in the 80.4, 80.5%, which was right around where they were. A couple, like I said, not even a full percentage point increase there, but improving. But the one thing that is interesting for both Alaska and Southwest was another important metric, which is PRASM, or passenger revenue per available seat mile. This is one of the most important metrics when you're looking at airlines, because it's basically saying...
So listeners should be writing this down.
Right, and that's the one you really want to look at, is how much revenue they're generating per seat on the plane, per mile that's actually flown, because that includes things like fuel costs and how full the plane actually is. So it's a very important metric to kind of keep track of. And if you look at these companies, Alaska's was down a little bit, Southwest very, very modestly up, but again, pretty flat line numbers when we're looking at increases on things like this. So, and it's kind of telling when you look at the big gains in terms of revenue or income that they got, or sorry, income, not revenue, and then look at the PRASM numbers where they're pretty modestly flat, you can pretty much kind of assume that a lot of these gains are coming from modest expansion in the company and a major benefit from oil and gas prices.
Is it a lot of people talk, all these articles I read and edit and occasionally contribute to talk about the automakers, GM and Ford or whatever, and they're selling just about as many cars as they ever have or arguably ever will. Is it the same case with both autos and airlines right now that this is probably as good as it's ever going to get?
I mean,
unless population explodes.
I think it really depends on where you're looking. Certainly in the United States, there is some room to grow with regional travel. It's still a growing industry, but it's an ungodly competitive industry. Like we said,
right.
When you have flatlining numbers on passenger revenue,
I haven't been able to. I can't believe the profits that these companies have been making these last few years. And you had David Tepper making a couple $1 billion off of buying them after the Great Recession.
Right.
Like I grew up, reading about Warren Buffett as a teenager, and rule number one: stay the heck away from airlines.
Well, you also have to take into account when you look at somebody like Warren Buffett, he's looking at it over
longer
across the cycle, and it looks like we're on one of the up cycles in the airlines where fuel is cheap, everybody wants to fly, economic conditions are good. So those are when the opportunities are. The big question will be is, can they carry some of that momentum into when oil prices start to increase? And that's going to be the biggest question for them going forward. How long is this party going to last with oil prices? And at the same time, when you look at those flatlining numbers for passenger revenue per available seat mile, it starts to wonder how much more competitive are these people going to get when it comes to fares and fees? Because let's face it, airline travel has become a race to the bottom when it comes to prices nowadays. That's why a company like Spirit Airlines, as miserable of an experience as it is to fly on a Spirit Airlines plane, I don't know if you've flown them. It wasn't exactly the best experience I've ever had.
Well, even with Southwest,
but it is cheap. Oh my goodness, is it cheap?
My flight to Port Columbus Airport in Ohio last week, I booked a month and a half in advance. My flight was $69 one way. On Southwest, I got peanuts and a Coke. It was great.
So, but again, it's the race to the bottom.
It is a race
to
the bottom.
Cheap.
They did not make money on me.
You have the dynamic pricing model where, you bought it a month out, and it's going to be a little cheaper than if you'd waited.
But
a
now
week.
It's $200. Yeah.
But so you have those sort of dynamics going on, and it'll be interesting to see what happens with fares, and we're starting to see a little industry consolidation with Alaska buying Virgin Atlantic and things like that. If industry consolidation does happen a little bit more, will they be able to raise prices a little bit because the amount of competition won't be as robust?
Right. All right. Well, before we dive into talking about Saudi Aramco's probable IPO, I wanted to point any listeners out there that are hungry for more foolish content to focus.fool.com, where all industry-focused listeners have access to a special discount on the Motley Fool's Stock Advisor newsletter. The discount works out to $129 for a full 2-year subscription. Once again, that is focus.fool.com. So, Tyler Crow.
Yes.
Saudi Arabia really, really, really wants to raise a couple $1 trillion, it looks like. Or at least, I don't know, a couple $100 billion from selling a 5% stake in what is the country's arguably only industry. Why didn't they do this a couple years ago?
Well, there's a couple things going on here, and I'm not going to delve deep into Saudi Arabian politics because
Nobody knows.
I don't know that very well, but as you've seen, there's been some rather vocal commentary coming out from the kingdom. Some of not the king, but some of his
various princes are saying this.
Are trying to get away from oil. We need to move away. They're trying to build this massive, basically sovereign wealth fund where they can start to wean themselves off of oil. And one of the ways that they want to raise money to get this fund off the ground is to IPO a certain segment of Saudi Aramco. Now, it's pretty modest here. They only want to sell about 5% of the business. And granted, that 5% is a lot because it's such a big company. But from an investing standpoint, it's going to be listed on the New York Stock Exchange, so you and I can buy it just like anybody else. But before anybody gets too excited about this, and I'm sure there's going to be a ton of media like, should you buy Saudi Aramco when it IPOs and all these things. Right now, we don't even know what the heck we're going to get. Like they said, oh, we're going to 5%. Does that mean 5% of the whole thing? 5% is just these certain segments of assets. We don't have the slightest clue what that necessarily means.
That was the most interesting part about, I think it was the Wall Street Journal article that I read the other day, and this was titled, Saudi Aramco IPO could be 5% of value. And as you said, value of what? The most interesting thing that I read was they're not even sure if they're going to include the country's oil reserves. I mean, as I understand it, the country is structured to where everything's the property of the Saudi royal family. So it seems to me like they could do whatever they want with all this stuff anyway. So I'm almost inclined to say, give me the refining assets and you keep the oil. I don't know.
It's one of those things again, too, where you're looking at a business that is trying to serve two masters. And what we have seen, at least in the oil industry over the past several years, a company that's trying to serve two masters like that in the terms of being a hybrid of a state-run oil company and being one that's publicly traded where it's beholden to returns, those can be conflicting things. And I think a great example of that is Petrobras in Brazil. Never mind all of the things that have gone on with the kickback scandals and the corruption and the things that have happened as of late. But if you had watched Petrobras at the early times, it was, we have this immense opportunity because we have these pre-salt fields. They're huge. We need to raise some capital. And they wanted this hybrid model where they could raise the capital and generate returns for investors over time. The only problem is that there were so many restrictions from the state-run side where it's like, well, you still need to subsidize gasoline prices within the country, so you're going to automatically take a loss on those. You have to have certain local content restrictions, so you can't be the most competitive on price all the times when in comparison to an oil major. And when you have those conflicting
contract out to just Brazilian companies,
right?
When it's all.
So when you have those conflicting interests, it can be very, very difficult to balance that. And if you look across, Petrobras, PetroChina, even Sinopec to a certain degree, it's very hard for a company to serve both of those masters well and to have everybody satisfied. And so, yeah, sure, Saudi Aramco might make 5% of it available. Is it going to be a great investment? It's really hard to tell right now.
The odds are low, yeah.
Don't go jumping in the minute you see it.
Right. What do you think? So you see this valuation of $2.5 trillion for Saudi Aramco. Maybe that includes the reserves or not. 5% of that, of course, would raise the country $125 billion. The whole number itself seems suspect to me because oil prices are at the low 40s right now, and that's after rallying over 50% from 26-27. Does that imply that the Saudi Aramco was worth $5 trillion 18 months ago? Like, I don't quite buy that. Like, where are they getting this $2.5 trillion number? Because I seem to remember that from a year or two. I'm like,
well, and you also have to take into account too that, right, the numbers that are given on these aren't necessarily beholden to SEC regulations on how you evaluate reserves, how do you evaluate your property, and things like that. And perhaps once they do go public on the New York Stock Exchange, they will have to disclose things like that, like what they're
and stuff.
And maybe once that happens, we'll get a little clearer picture and some transparency into a business that has been very opaque for a long, long time.
Yeah. So before we head out, Tyler, I want to get your thoughts real quick. Can you tell our audience really quickly why, if your stock falls 50%, a CEO shouldn't get a 20% raise?
Well, at least that's what a couple companies have said recently with some shareholder votes. Both Anglo American, a major diversified mining company, and BP, both in their shareholder votes, both companies had either large plurality or a majority of their shareholders saying no to the pay packages that were proposed by the board for these company CEOs. In the case of Bob Dudley, who's the CEO of BP, he was looking at a 20% raise to about $19.6 million annually. And
which is absurd.
It all comes down to how you evaluate what how you structure your compensation packages. And if you look at some of the ways that BP had structured it, it was rather favorable to the business on these certain metrics that looked favorable almost regardless of the current price environment or the total return that a shareholder would get. Contrast that with some like ExxonMobil or Chevron CEOs. Both of them saw pretty decent sized declines in their salary from 2014 to 2015 because their compensation packages were based somewhat on total return. And when you have your stock drop 20%, 30% in a year, some of that is going to be reflected in your pay package. So this is one of those things, and I think as a shareholder, it's kind of one of the nice things where you can actually say no to something like this and actually have a voice in it. And that's one of the great things about being an individual shareholder of a company is you, as little as it may be, you still have a voice in what goes on in the company. You can say, hey, you guys are paying your CEO too much, or you can sometimes bring up amendments for like oil companies. You see a lot of them. They have to bring forth votes on things like climate change disclosure. So it's encouraging to see shareholders actually holding companies' feet to the fire for a change, because it's
right.
Sometimes these guys can get away with a few things every once in a while, and to see this happening is a little encouraging.
Good. Well, thank you once again for your thoughts, Tyler. Always a pleasure.
Thanks.
And if you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Once again, that is industryfocus@fool.com. And as always, people in this program may have interest in the stocks that they talk about, and the Motley Fool may have formal recommendations for or against those stocks, so don't buy or sell anything based solely on what you hear on this program. For Tyler Crow, I am Sean O'Reilly. Thanks for listening, and Fool on.